Let's get right to it. We have Yu-Dee Chang. He is Ace Investment Strategist Chief Trader, who's going to tell us why an interest rate hike could actually be good for the equity market. Kimberly Foss, Empyrean Wealth Management founder and president, will tell us what she's adding to clients' portfolio right now. And Bob Iacchino is joining us from the CME. Bob, I want to start with you. You say you are bullish, Bob, but you also say that this is not the spot to buy into the market. Why not?
David, I knew you were going to be the one to ask me that question. I thought of it as I was stepping up here, and the reason is we're not seeing the kind of strength I need to see. Last time I was on with you, I said I'm bullish, but I'm not buying here. We're not seeing bottoming yet. We're just seeing sideways trade in the midst of that down move we saw last week, and I think there's a lot of reasons that it may continue, not necessarily fundamentals, but EPS has been good, top-line revenue has been good, stocks can't get out of their own way, maybe because of geopolitical tensions, but we're going to need something else to push us higher. And once earnings season is done, I'm not sure that we have it.
Bob, that is a perfect way of outlining it, except that the one question we now ask our pundits as well, are people who've got their real hands right now in the money, are these short-term concerns or long-term concerns, Kimberly?
You know, we are actually short-term cautious, but long-term very optimistic. And yes, there are concerns out there, but with the geopolitical concerns, you know, the Russia, and you've got in Italy in recession, and you've got the Middle East issues. But these are great opportunities when the markets do pull back, Liz, 4 or 5%, to micro rebalance and add new monies to the portfolios. And that's exactly what we're doing.
Yu-Dee, let's talk about inflation for a second here and the relationship between interest rates and inflation. For most of the past 30 years, and we now have a chart to show this. I mentioned it yesterday, but for most of the 30 years, we can see there that interest rates were higher than the inflation rate. That means that you could make money by saving money. Right now, you cannot do that. And until the Fed changes that, raises rates above the rate of inflation, I don't see any place to put your money but in equities.
Well, that's exactly what the Fed has been trying to do, right? They want to try to push the money to the so-called risky trade, thus stimulating the economy, and it's working. That's why we are still at this point talking about when to get back to the market.
Let me reemphasize something here. For most of the past 30 years, the booming 80s, the booming 90s, and most of the last decade that was booming, we had interest rates higher than inflation. We are not going to boom unless we get interest rates above inflation.
Yeah, well, I wouldn't necessarily say that. I mean, right now, I think inflation. So you're saying that in order for ours to boom, then we need to see a little bit more of a robust economy, thus spurring on some type of inflation. Well, that theory could be true too, and that's why people are starting to talk about this economy as it starts to pick up steam a little bit. The labor wages may trigger the inflation, which may in turn make the Fed prematurely or raise interest rate a little bit sooner than what they would do. So. You know, what you're saying could be very correct, that in order for the economy to get more robust, we do actually need higher interest rate. Higher interest rate is actually good for the market.
Bob, down at the floor of the CME, how closely did they look at the JOLT survey, the job openings and hiring? To me, I looked at this, I said, this is a pretty fantastic number. In many, many years, it has become the highest where we saw the most job openings. Does that not then translate to the Federal Reserve starting to think maybe we need to get closer to tightening rates? And what are the guys on the floor saying at the CME?
There's a couple of great points about that. Also, the quit rate is moving up higher as well. Quit rate, for those people who don't know, is where people are willing to leave a job because jobs out there are plentiful, so they're willing to quit their job and move on and try and find another one.
Right.
Lines up with the JOLT rate, right? And that has been mentioned, and it needs to translate into non-farm numbers and needs to translate into a shrinking labor pool. We haven't quite seen that yet. But back to the point about inflation, you know, the thing that's strange is we're in a completely unprecedented territory, and that's why, Liz, I don't think the Fed will act on that. The Fed is on their own agenda, in my opinion. We have a Fed-driven asset inflation, not a demand-driven asset inflation. Asset inflation brings price inflation when it's natural, when it's organic. We don't know if asset inflation, equities, real estate, when driven by the Fed, will bring price inflation as well. And therefore, I don't think they're going to move interest rates anytime soon.
Kimberly, there are some dangerous signs of what's happening abroad in Europe. Just when we thought Europe was out of the deep stuff, Germany gets back stuck in it. And some of the stats coming out of Germany are very troublesome. Will that affect our market in any way?
It could have some ripple effects, but the reality is, David, that, nobody knows what the Fed's going to do or when they're going to act or what the global markets will do in the long run. But an investor, needs to be invested for the long term. And so it's really up to the allocation of the portfolio and their ability to stay in the markets, regardless of what the markets are doing, commensurate with their ability to stay there and then gain, on the dips, rebalance the portfolios on the dips so they can gain in the long term. The idea of timing the market is really a very, very difficult thing to do. And what we tell the clients is really it's not timing the markets, it's time in the markets.
That's a good way of putting it, Kimberly. But then you're picking two names, GE and ConocoPhillips. Both do. I mean, ConocoPhillips has a pretty decent dividend. But why do you like these two names?
We also love those because I believe in value investing, and we're tilting more towards the value investing right now. Those happen to be two of the largest holdings in our value mutual fund. Liz, we're fully invested in 44 different countries and over 12,000 different stocks. So those happen to be just two of the largest holdings in the value sector. And they pay dividends of 3.2%. So you get paid while you're holding the stock as well.
Yu-Dee, I'd like to talk about financials for a second. We had some very good numbers of profits from the banking sector today. They're making money hand over foot. On the other hand, some people like J.C. Peretz, who we had on yesterday, look at the technical charts of financials and say now's not the time. You like financials right now. Why?
I do like financials. Actually, if you look at the financial charts, I like it even more. This is a consolidation pattern that we think is going higher. But basically, it's this. Financials, they pretty much got rid of all their woes of 2008. They have been able to benefit from this low-yielding, low-interest rate,
and they're
low-growth
lending money.
environment.
They're lending money like crazy right now.
Yeah, absolutely. And that's why I think if the rates ever go higher, the economy ever gets a little bit more robust, their profit margin will even be higher. They will even make more money. So I think they're poised to take advantage of higher interest rate, and they're still are able to make money during this low rate environment. That's why I like the financials going forward also.
Yu-Dee Chang and Kimberly Foss, great to see you. Bob, we will come back to you, okay, shortly for the futures close. We want to see that.
Thank you, folks. Well, Robin Williams had a huge impact.